Hello, I'm Terry Smith. I'm the founder and CEO of Fund Smith, the asset management business, and also the portfolio manager of the Fund Smith Equity Fund. I'd like to welcome you as investors in the Fund Smith Equity Fund through the feeder fund that's been put together by Mizuho and Asset Management One, and welcome you as investors. Now, what I would like to do in this brief introduction to our fund is tell you something about Fund Smith, our business and our philosophy, and about the fund that you are invested in. Now, I founded Fund Smith with my own money after decades in the securities industry, running investment companies and as an investment analyst. And I did so with a small group of like-minded individuals whom I worked with for many years. For example, my partner and head of research, Julian Robbins, and I first worked together 35 years ago. We all have a lot of our money invested alongside you in the fund, which I think is extremely important. And we have a single objective at Fund Smith, which is to manage the best fund in the world in terms of the returns that it gives you, taking account of the amount of risk and volatility that you experience whilst you're holding it. And that is our primary focus. Now, what's our investment strategy at Fund Smith? How does it work? I'd like to take a little bit of time and take you through that, because I think it's important that you understand what we are doing for you so that you can make good investment decisions around your investment in our fund. We have a very straightforward and simple investment strategy. We try to only invest in good companies, good businesses. Then, when we've identified what we think are good businesses, we try not to overpay or pay too much for our investment in the shares. And then finally, if we've found good companies and we've invested at what we think are good prices in their shares, we try to do nothing. We try to remain inactive. I want to take you through each of those in turn, if I may. First of all, invest in good companies. This is by far the most important thing that we do. It's important, we think, to invest in good companies because only that way can your investment be guaranteed to compound in value over time. What do we mean by a good company, though? We mean a company which has got a high return on capital that's invested in its business. Last year, the companies in our portfolio had about a 26% return on capital employed. That's very important because they retain about half of their earnings every year. They pay about half out in dividends, they retain about half. The half that they retain is reinvested, and if it earns the same return that they're currently getting on their business, 26% on average, clearly it will deliver a very good return for us as investors. Now, we have lots of other items that, in our view, define a good company. We expect the company to have very good profit margins, both gross margins and the operating profit margins. We expect to be very high. Our companies have gross profit margins of about 65%, and they have operating profit margins of about 26%. Now, it's very high compared with the companies in the index. We also expect our companies to generate cash. In the end, there's nothing else that can be used to pay the bills and the dividends that we expect to receive. Our companies convert at least 100% of their profits in cash. Those of you who are not investors and don't study investment analysis may be rather surprised to find that on average, most companies only convert about 80% of their profits into cash because they have to invest in things like working capital. So our companies that we look for have these fantastic financial characteristics. We only find about 70 companies worldwide that fit through our very stringent filters to make them investable. And when we are compiling a portfolio for our fund, only about 25 to 30 of those companies are invested in out of the 70 that we identify. It's not only financial characteristics of businesses as well. We want businesses that are able to defend those returns. It's very important to us that if we have a very good business, that it should be able to fend off the natural competition that seeks to get into the same line of business as them. And this is what Warren Buffett, the very famous investor, terms the moat. A moat is something that would be used to defend a medieval castle, often filled with water, a big ditch. The moat for our companies, though, are things like brands. Powerful brands enable them to defend their prices, their control of the supply chain for the ingredients that go in to make their products, the control of distribution in getting their products into shops and restaurants and bars. Those are the sort of things that we seek. Sometimes it's about installed bases of equipment or software, people who've got software installed to use for payroll processing or for airline reservations or for operating systems. Those are the sort of companies which have got got very defensible competitive positions because people don't like to change very much. Sometimes it's installed equipment, things like testing equipment or elevators and escalators, where they have a tame market for the consumables and the spares and the service. You hear a lot about sustainability when it comes to investing these days, and we are thoroughgoing believers in investing in sustainable businesses, because if, like us, you are long-term investors, you must try and seek sustainable businesses. Our average company in our portfolio was founded in 1926. They're nearly 100 years old, these companies. They've survived some very extreme events, world wars, depressions, economic downturns, and they're still with us and still prospering. It's quite likely, therefore, that they will continue to prosper whilst we hold them in our portfolio. And last, but by no means least, we look for companies that make their money from everyday necessities and luxuries, things that we do every day. When you brush your teeth, when you clean the bathroom, when you eat, when you drink, when you feed pets, when you have a medical procedure and they use equipment, devices and drugs. These are the sort of things that we like to invest in. So that's what we seek. First and foremost, good companies. And that's very important, as I've already said, because those companies, by reinvesting in their very powerful businesses, can generate fantastic returns for us. Now, once we've identified our 70 or so good companies that we are willing to consider investing in, as I've said, we select a subset, usually 25 to 30 shares for the portfolio. We do that basically on which ones offer the best value, because it's all very well to have a good business. What we're looking for are shares which are cheap, or at worst fairly valued to invest in. And what we do is we compare the valuation metrics for our companies, things like the cash flow that they generate compared with their market value, known as the cash flow yield. We compare that with each other to see which offers the best value. We compare them with the remainder of the market. We compare them with other investments like bonds, and we try and select those companies which offer the best value at any point in time to populate the portfolio that we invest for you. So we seek to invest in good companies, and we try not to overpay for the shares. Lastly, we try to do nothing. Once we've identified these good companies and we've constructed a portfolio, we try not to deal. Why? Dealing costs money. When you deal in shares, there are commissions to pay to brokers, there's the bid-offer spread between buying and selling shares, and there are quite often taxes to pay on transactions as well. Clearly, by not dealing, we avoid those. Our turnover in our company is typically way less than 10% in our portfolio every year. Usually lower than that, can be as low as zero from time to time. And the amount that we spend on this is therefore very low. If you take last year, 2020, our turnover in what was actually quite a dramatic year in terms of the stock market only cost us 3 basis points, 3/100ths of 1% is what we spent on dealing, which is by industry standards extremely low. This is probably the lowest dealing cost fund of its type in the world, I would suggest, when you look at the comparison with other people. And that elimination or minimization of dealing costs gives us a big advantage in delivering returns to you. It also helps us to not make mistakes. By and large, if you've got really good companies in your portfolio, it's best to hold them through the ups and downs that you get from time to time, which inevitably occur in economies and in businesses, and hold on to them and let them compound in value. And a great man, Warren Buffett, the investor, once said, the stock market is a mechanism for transferring wealth from the busy to the patient. We are the patient. On your behalf, we are very patient about getting good returns out of our companies. So that's our investment strategy. Buy good companies, try not to overpay for the shares, then do nothing. And so far, it's served our investors well. Over our life so far, we've compounded in terms of returns in hard currency at over 18% per annum, which is obviously very good. It's about 6% more than the index over this period. And I would assure you as investors that that is what we are in single-minded pursuit of. That's all that our business does. It doesn't do anything else. We are purely here to manage the Fundsmith Equity Fund and welcome you as investors through the feeder fund. And thank you for your support.